Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to get started today with the economic data because we have a pretty consequential next couple of weeks coming, although we're off to a somewhat slow start today. Not a lot going on, just some information about the manufacturing sector and sales and inventories. Tomorrow we get information on the real estate market, but most importantly, consumer confidence, which is one of those key factors that determines whether we're seeing, a potential recession in progress or about to occur, because the consumer, which is about 2/3, a little bit more of our economy, is starting to close the wallet. We'll get more manufacturing information about durable goods. That's important. Big ticket items, whether they're continuing to grow in terms of sales, or is there a slowdown going on there. We'll get GDP, which is expected to come in at 2% versus the prior reading of 2.6. That's a deceleration that's expected, and this number right here could come in worse than expected. If it does, that has mixed implications for the market. It's not as important as it would have been a few months ago, due to the fact that it's widely viewed that the Fed is nearing, if not at the end of its rate hiking cycle. We'll leave for future discussion some of the commentary to the effect that we'll see rate cuts this year for another day, but in brief, we don't expect to see rate cuts this year. With that said, information about consumption, information about prices. This core PCE is the Fed's preferred inflation number, and you can see it's expected to come in at 4.7%, which is still much hotter than the 2% the Fed generally targets. So it'll be interesting to see that. That will give us a big clue as to what's going to happen, and a hot number here could really cause the market to get irritated and come down a bit. We'll get more information about sentiment, manufacturing sector, factory, and durables again. But the big item here is the rate decision by the Federal Open Market Committee on the 3rd. And that's expected to come in with another 25 basis point rate hike. And largely believed by analysts to be the last in this hiking cycle. However, that PCE number and all indications point toward potential need for the Fed to keep going beyond that. And if the Fed comes aggressively here, potentially we could see some turbulence in the market. And if they don't do anything, we think there could also be some turbulence in the market. So this day might be a little bit wild. We'll get information on productivity in the labor market, and that rounds out our next couple of weeks in economic data. And let's talk about the markets. So the S&P 500 has been very placid over the past couple of weeks, the whole month to date. And that's largely because there has been a slowdown in the pace of economic activity, or the data points coming out over the past few weeks. But also after the panic of the banking system receded a bit, there's really not been a big catalyst for the market to go which way, either way, whether it's up or down. And over the next couple of weeks, looming larger are two things. One is earnings season, which we'll talk about in a few minutes, and the other are these data points, which we just went over, any of which could potentially push us up above that key 4,200 level or down below 4,000 on another retest, potentially to 3,800. So we're watching. The market's in a holding pattern. And volatility has notably declined. So this is the VIX index, which measures volatility expectations over the next 30 days. Essentially, at one point, late last year, at several points last year, we were up in areas where you'd expect 3% moves, plus or minus every day, based on this indicator. And we got up to a pretty panicky level during that banking crisis. Anything above 30 is considered to be pretty extreme in terms of negative market sentiment and fear. And we're all the way back down below 20, and this is actually notably lower than it's been in quite some time. And that signals that market participants are viewing things to be pretty good in terms of a reduced expectation of volatility, which is a condition that could be seen as a bullish factor. Here's another one. This represents our earnings season so far. Now, to be fair, we've not even seen a full 10% of the S&P 500 report. However, the surprises have been to the upside in terms of sales and in terms of earnings. And this has had some of the analysts out there a bit perplexed. How is that happening when we're expecting a recession? And we'd like to highlight one thing, and this is a very key point. We've got here the producer price index on the year-over-year basis compared with this with the consumer price index on a year-over-year basis. So this measures the spread between how fast producer prices, in other words, input costs, have been rising, to the amount that gets charged off to the consumers. And this can be taken as a proxy for corporate profit margins, because profit margin is your sales minus your costs. So for a very long time, starting in early 2021, producer prices were rising at a much more rapid rate than consumer prices. And the spread here got so bad that at one point back in June of 2022, there was a almost 10% differential. In other words, producer prices or input costs were going up by more than 10% higher than what consumer prices were going up that they could pass along to consumers in sales. This was a very bad catalyst for markets. Markets do not want to see declining margins. That's one of the catalysts that leads to bear markets. And not coincidentally, if we go back and look at the very beginning of 2022 and move in, we did in fact see a bear market in 2022. And it was largely based on this perception that corporate profit margins were declining in our view. That pressure has abated, and now there's a positive spread here, meaning that the consumer price index is actually rising a little bit faster than producer prices, or alternatively, and probably a better way to look at it would be to say that producer prices have actually potentially turned the corner and started on a downward trajectory, and consumer prices are slowing their pace of advance. So that's particularly bullish for the market if this continues. So if we continue to see the indications that margins are going to be growing again on a forward-looking basis, we would expect the markets to start trickling up in anticipation of a recovery, even if we get information that says GDP is declining and that we're in a recession. So with all of that said, hopefully you found this video informative. If you're concerned about markets or your portfolio, please give us a call and we're happy to talk. Thanks. Have a great day.